Few individuals regularly consider the Federal Reserve, and even fewer consider how the American central bank affects investors. However, that has started to change in recent years. Many analysts and sharp market observers are arguing that years of easy monetary policy from the FED and other central banks during the Great Financial Crisis contributed to the creation of an everything bubble, which is now popping. The concept of the everything bubble is not new. Leading Wall Street thinkers, including investing guru Jeremy Grantham, had been warning about a developing superbubble for years, even before the stock market problems of 2022. The financial historian and co-founder of GMO is most recognized for having correctly predicted the last three market bubbles. He emphasized a number of warning flags, including investor euphoria, inflated prices, and widespread speculation in dangerous assets like meme stocks and cryptocurrencies. In a research report last year, Grantham issued a warning that this enormous superbubble, including stocks, bonds, and housing, was on the verge of collapsing. In the research note that was released on August 31st, 2022, Grantham confirmed his prior forecast that the US markets will experience a terrible crash, and he also discussed the significant indicators of an impending economic slump. The belief is that near-zero interest rates and quantitative easing, which involved the FED purchasing mortgage-backed securities and government bonds to increase lending and investment in the economy, is said to have encouraged investors to make riskier bets, allowed unviable business models to prosper on low-cost debt, and fueled a savagely unhealthy rise in home prices. The seasoned investor brushed aside the recent increase in stock prices, calling it a temporary respite and noting that prior bubbles have usually been followed by market falls of at least 50%. He described how a bad mix of circumstances threatened to harm asset markets and global development. In addition to aging populations and workforce shortages, he pointed to declining business profits, high inflation, interest rate increases, food and energy crises, pandemic disruptions, the Russia-Ukraine war, and other longer-term problems. Each cycle is different and unique, but every historical parallel suggests that the worst is yet to come, he said. This remark comes in the wake of months of turmoil on Wall Street, a number of difficulties, and indications that the US is already experiencing a quiet recession. All three major asset classes, housing, stocks, and bonds, were historically overvalued at the end of last year. Now we're seeing an inflation surge and rate shock, as was seen in the late 1970s as well. He pointed out that those three asset classes had grown excessively overpriced the previous year, and that when paired with rising inflation and interest rates, they will soon turn poisonous once the market crashes. And to make matters worse, we have a commodity and energy surge, as painfully seen in 1970 and 2007. And these commodity shocks have always cast a long growth suppressing shadow, Grantham said. He claimed that continued pandemic-related curfews in China, the conflict in Ukraine, and food and energy shortages had all combined significantly to market shocks. In addition, he predicted that the long-term effects of declining workforces, owing to low global birth rates, will result in a wide and persistent food and resource deficit, which will be made worse by increasing climate harm. These few epic events seem to act accordingly to their very own rules, in their own play, which has apparently just paused between the third and final act. If history does repeat itself, the play will once again be a tragedy, and we must hope this time for a minor one, declared Grantham. Each cycle is different and unique, but every historical parallel suggests the worst is yet to come, he concluded in his report. Grantham also stated that he is betting against high-yield trash bonds and tech stocks in the Nasdaq index through his $1.5 billion charitable foundation. The investor claimed he anticipates making money from a significant collapse and crash as tech stocks and junk bonds tumble and business defaults rise. The renowned investor has warned everyone to get ready for a crash in growth stocks, upheaval on the housing markets around the world, and rising mortgage rates that will hurt homeowners. He claimed that the worst inflation in over 40 years, along with the Federal Reserve's lack of action, has degraded investors' actual returns over the last year, turning a marginal bear market into a rather serious bear market. People forget to adjust the S&P for inflation. Your assets are worth 9% because of inflation in the last year, he said. What I don't know is, does that get out of hand like it did in the 30s? Is it pretty well contained as it was in 2000, or is it somewhere in the middle? Grantham pondered. How far do you foresee the inflation to go? Let us know down below in the comments. And also make sure to like, share, and subscribe if you haven't already. We'll see you in the next one.